So today on the call, we've got Tsepo Headbush, who is the CEO of Brighton Capital. Hi, Tsepo.
Hi, Heidi.
And we've got Koena Headbush, who is Tsepo's cousin and co-founder of Brighton Capital. And Koena is head of operations here at Brighton Capital. We're really pleased that everyone has joined us today to hear more about how to access working capital after the lockdown. We are broadcasting out of Johannesburg, South Africa. We are a local-based company, and we specialize in working capital finance to small businesses. We will start with a brief presentation of about 20 minutes from Tsepo, who will go through his insights as to what lenders and supplier businesses consider when extending loans and credit to small businesses. We will open up the Q&A at the end of the presentation, but you are welcome to ask questions via the Zoom conference. If you have a look at the bottom of your screen, you will see a little bubble box which says Q&A. If you click Q&A, you will be able to write a question in the chat box or raise your hand to ask a question. We will keep questions for after the presentation. And we will unmute. At the moment, everyone is on mute just because it's a webinar and just to keep the noise levels to a minimum so everyone can hear. But after the webinar, if you do have a question, we'll be curating the questions during the webinar and then opening it up to all the participants at the end to ask your questions. But feel free to ask them in writing in the Q&A field, and we will open it up afterwards. So what is the time? It's just past 2 o'clock. Tsepo, perhaps you'd like to just introduce yourself and tell our audience what your background is and how you've come to be CEO of Brighton Capital, and then we'll go over to Koena. He can give us a little bit of a background, and then we can start. Go ahead, Tsepo.
Heidi, thanks very much for that. I really do appreciate that. Good morning or afternoon, everybody. Thank you very much for joining us on this call. Just by way of introduction, I'll let Koena, my co-founder and cousin, share with you a little bit of background on Brighton Capital. But just from my perspective, before I start on the actual presentation, my name is Tsepo Headbush. I am the CEO of Brighton Capital, as Heidi mentioned. We established Brighton Capital around about 5 years ago. And when I'll get into detail in terms of what Brighton does and what Brighton is. But by way of my background, I am CEO of Brighton Capital. Prior to becoming CEO of Brighton Capital, I founded and established a division within Bright South Africa, which at that stage was the largest private equity fund in South Africa. I established a $100 million or billion rand fund of funds program in that business. And before that, I managed a 2.5 billion rand fund for Eskom pension fund, which did very well. And then over the last 5 years, really been working on establishing and growing and developing the Brighton Capital platform and assisting and aiding SMEs to access working capital funding.
Afternoon, everyone. Before I get into what Brighton does, let me just quickly do an introduction of myself. As mentioned before, my name is Koena Headbush. I'm the head of operations. So my background, basically, I've been in technology for over 10 years now, focusing mostly on the operation side of things. I was fortunate enough to study IT at University of Houston in the US. Worked there for a little bit before coming back home. And when I came back home, obviously stuck with the technology, and I was part of the initial team that launched iBurst. And iBurst, if some of you remember it, was one of the first wireless internet technologies that we had in South Africa. This was before mobile internet on our cell phones was the norm for everyone. So ever since then, I have been always interested in technology and to see how we can use technology to improve our lives, to make our lives a little bit simpler, so that it enables us to focus on the things and the people that we love. So that's basically a little bit about me. And then just a little bit about Brighton Capital and what we do. So basically, Brighton Capital is an online SME lender. Okay, so We provide various forms of working capital funding facilities. These facilities for invoice finance, purchase order finance, and contract financing facilities of up to 1 million rand. Okay, so facilities can be approved within 1 business day, and clients can draw down on their facilities within 4 hours after submitting a loan application. Now, we all know that if you are an emerging business with less than 5 years trading history, getting a loan from the banks is not always possible, very, very difficult. So what we have done at Brighton is try to make it as simple and as seamless as possible for small businesses to get access to funding in places where we felt was most needed. By that is enabling them to execute on sales or purchase orders that they've received from their clients. Okay, so we try to make our processes as simple as possible. Everything is done online. So please feel free after the webinar to just have a look at our website at brightoncapital.co.za, and I'd be happy to chat with anyone if you need any more information in that regard. And then lastly, just to touch on our funding partners. So we've been fortunate enough to being backed by some businesses who have enabled us to be able to provide affordable funding to small businesses. Some of our funding partners include Glencore Operations, African Bank, as well as Rand Merchant or RMI, Rand Merchant Investment, who are also part of, who are also the guys behind FNB on that side. And I think that is a little bit about us. As I mentioned, please feel free to look at our website, and I'd be happy to chat with anyone after the webinar is done for any more information about us. Okay. Tsepo, you can go ahead, and I think, are we starting now, Heidi?
Yes, I think, thanks so much, Koena. I'm just going to go back to the slide where we see your 2 smiling faces from earlier this year when we announced that funding from RMI. So thanks for that introduction, and I'm going to hand over to Tsepo now to go ahead with the presentation. Go ahead, Tsepo.
Heidi, thank you very much. Guys, these are exceptionally interesting times. And I know that some of the businesses are struggling, and I know that the biggest concern at the moment is cash, 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 cash. And obviously, in order to generate the cash, one has to make sales. But just to give you where we are in terms of small businesses and the funding available at the moment. And I'll get into how best to access funding, either from lenders such as ourselves, banks, and obviously suppliers in terms of accessing credit terms. But by way of introduction, I don't know if most of you are aware from the media reports that National Treasury is about to launch 100 or 200 billion rand guarantee scheme that will be administered by the banks. I hope the objective of the scheme is to enable small and medium enterprises to access the necessary funding to support their operations over the next 3 months. Government recognizes that liquidity, or more specifically, the availability of cash to meet operational expenses, is the largest challenge SMEs are facing or are going to face with the lockdown or after the lockdown. Our government recognizes that most of the small businesses do not have large cash buffers available, as such, may not have the sufficient cash resources to pay operational expenses for any sustained period of time without the inflow of revenues. We actually did some research. In the US, research found that the average SME in the US does not have more than 30 days of cash reserves available on its balance sheet. This cash buffer here in SA is probably a little lower, if not much lower. Should a business run out of cash, and that business does not have access to external funding sources, that business will lack the ability to meet its short-term obligations. And its inability to meet these short-term obligations will result in a business being unable to continue trading, resulting in an obvious closure of that business and the unfortunate loss of jobs. And this is really the basis of why the government has created this guarantee scheme. The guarantee scheme has been created to solely aid small and medium businesses access liquidity. Government is trying to ensure that South Africa's economic engine, at least in the case of SMEs, does not run out of the key oil that is necessary to sustain this economy, and is doing everything in its power to avoid the economic engine from seizing, which would obviously be disastrous for job creation and for the resultant tax revenues that the government collects each year. So the key objective of the guarantee scheme is to provide liquidity to businesses and ensure that they are able to sustain trading over the next 6 to 12 months through the COVID crisis. So even though banks are competitors, I urge every single one of you on this call to apply for the funding available under the scheme. It is our understanding and from our research that the cost of the funding will be at a fixed interest rate of below prime, the current prime lending rate, which at the moment is very low, and loans will be repayable over up to a 60-month period, 5 years. And businesses will also be afforded payment holidays of at least 6 months. Our role at Brighton is to ensure your sustainability and growth of small businesses. And if small businesses are not sustainable, then our business is definitely not sustainable. Our job today is to help you prepare your business to access funding from either us, the banks, or from your suppliers. And the best way to prepare is to understand the factors we, other lenders and suppliers consider when extending loans and credit terms to SME. So, how do you can go to the Access Your Funding page? In determining whether to extend a loan or credit terms to an SME, credit providers, and I'm going to use the all-encompassing word of credit providers, which obviously will include lenders and suppliers. Credit providers seek to assess an SME's credit risk and affordability. When I refer to credit risk, I'm referring to an SME's ability, the ability of the borrower to meet its loan obligations. In determining the SME's credit risk, credit providers will also analyze the likelihood of the borrower defaulting on its loan obligations, which in banking is commonly referred to as the probability of default. In terms of affordability, affordability refers to the size of the loan that a borrower can sustain or afford. In determining affordability, credit providers also determine whether in the event of a default, how much of its loan can the lender recover? This recovery in the event of default is commonly known as a loss given default. This loss given default can be enhanced and improved by requiring a borrower to provide security for that loan. And we'll discuss that a little later. So in assessing the SME's credit risk, credit providers typically assess 3 factors, namely a business's profitability, its liquidity, and its solvency. In terms of profitability, credit providers assess the business's ability to generate profits, and actually more importantly, the business's ability to generate free cash flows. And I want to stop here for a second and focus on this term, free cash flows, because in lending, it is everything. So let me define what free cash flows is. Free cash flows is the cash left over in the business after the business has paid all its operating expenses and all its annual capital expenditure. CapEx in this context includes the business's investment in property, plant, and equipment, and nowadays in its technology as well. Effectively, free cash flow is the cash available to the business at the end of the period to either pay its debt service obligations and or to pay out the cash as dividends. So it's effectively the business's disposable cash to meet its loan repayments or to pay out as dividends to its shareholders. Very simple concept, but critical to the concept in lending, the term free cash flows. In respect to liquidity, credit providers assess the business's ability to meet its short-term obligations, including supplier, salary, and loan repayments, amongst others. Effectively, credit providers assess whether the business has sufficient current assets, and we'll talk about that in detail, or generates sufficient cash flow to meet its obligation, which enables the business to continue trading. And as I mentioned earlier, what government is trying to solve at the moment is to make sure businesses have access to liquidity so that their ability to meet the operational expenses or meet its other broader short-term obligations, which will enable it to continue trading. Then lastly, solvency. So solvency, credit providers assess the business's solvency or its capacity to meet its long-term financial commitments, or its ability to meet its long-term liabilities when they become due. The quickest way to determine the solvency is to assess whether the business's tangible assets exceed the business's total liabilities, which means the business is solvent. So from there, if we understand those factors, the next question is, what information do credit providers rely on to assess an SME's credit risk? Credit providers assess various types and sources of information when assessing an SME's credit risk. The most common types of information include the business's credit history, and I'll go into detail on each one of these, the business's bank statements, and the business's financial statements. So now let's discuss the question we get asked most in our business, the issue of the credit bureau score and the business's credit history. All credit providers pull the business's credit history from the credit bureaus to assess its payment history, to determine how well a business pays its credit obligations. Unfortunately, and this is a very, very important point, there is very little public or independent credit information available on small businesses, which is unlike the amount of credit information available on consumers. And we ask why. Well, many years ago, the consumer credit industry created an industry body called the South African Credit Risk and Reporting Association. Some of you may interchangeably use the term ITC, TransUnion, but all the data is collated on a monthly basis by this organization. The acronym is SACRA, which on a monthly basis collects and collates all the credit information from all the country's registered credit providers, including consumer lenders, insurers, retailers, and many other providers who provide goods and services to consumers on a credit basis or on credit terms. On a monthly basis, every credit provider reports to SACRA how well their individual consumer clients are paying their credit obligations. This huge collection of payment data provides credit providers a very good view of how well individual consumers pay their credit obligations. And this provides credit providers a good sense of whether to extend credit to a consumer or not. Unfortunately, SACRA does not perform the same function for SMEs, and such a database does not exist. As such, and this is very important, even though we can pull, or credit providers can pull SME's business credit score from the credit bureaus, this credit score relies and is heavily weighted on the payment history and the consumer credit score of the SME's directors, i.e., how well each director pays their personal credit obligations is a significant determinant of the business's credit score. The only publicly available information on the actual SME is when there's a court judgment against that business. And that's it, because there's no other publicly available information. However unfair you think the use of a director's consumer credit data is in determining the credit score of the business, the fact is the credit provider has a view and believes that the director's consumer credit history is a fair and reasonable proxy for the business credit position. The question is why? There's actually quite a reasonable reason for it. And the reason is very simple. In the case of small businesses, if the business is generating sufficient profits, the free cash flows that business generates would allow the director to draw those cash flows from the business, which would and should enable the director to meet their personal credit obligations. However, if the director is unable to meet their personal credit obligations, it is reasonable to assume that the business is not generating sufficient free cash flows to enable that director to meet their personal credit obligations. Further, It also illustrates that the director, who is most likely the shareholder of the business, may lack the personal financial resources and or capacity to support the business should the business undergo any form of financial distress or face any financial challenges, as is clearly the case in this COVID crisis. So the business credit history extracted from the credit bureaus is not a perfect indicator, but is deemed to be a fair proxy for the business's credit position. Going forward into the business's bank statements. In determining whether to extend credit history to a small business, the most reliable and most important source of data is the business's most recent bank statements. Bank statements allow the credit provider to assess and determine the business's cash inflows and also be able to establish the nature of these cash flows. So bank statements allow us to establish a source and nature of these cash inflows and determine whether it is revenue, investment income, or loan receipts. If the source is revenue and the revenue is sales, we can then inquire and establish whether those sales are recurring active sales, non-recurring ad hoc sales. In terms of the cash outflows, the bank statements are also good at determining the cash outflows and establish the nature of the cash outflows. Establish whether the cash outflows are fixed costs, most likely for the use of the payment of sales and administration costs, namely staff and rental costs, whether the cash outflows are variable costs, most likely in the form of cost of sales, or whether those cash outflows are for loan repayments, which establishes whether the business has existing loan obligations or other long-term financial commitments. So bank statements primarily help the credit provider to determine whether the business, at least historically, has the ability to generate revenues, generate profits, and free cash flows. And from this, the credit provider can extrapolate whether the business going forward has the ability to continue generating these profits and continue generating free cash flows. And these free cash flows can be utilized to service new debt. Lastly, financial statements. And we need to go deep into financial statements. And the reality is some small businesses are weak in their financial reporting. And this is an inhibiting factor, particularly when looking to raise money or borrowings from banks. Because financial statements are a critical source of key data. So credit providers seek to determine a business's liquidity and solvency from the financial statements. And it's a lot more difficult to assess this liquidity and solvency. So determining the liquidity and solvency of a business is a little harder, as lenders have to rely on the financial information and documentation supplied by the SME, which is not always reliable and can be easily manipulated. These documents include, amongst others, the business's annual financial statements, management accounts, and debtors age analysis. Debtors age and creditors analysis. Debtors and creditors age analysis. If the financial statements can be relied on, as indicated earlier on, these are amazing sources of key data for credit providers. If reliable, the credit provider can perform various analyses to determine the business's profitability, liquidity, and solvency. However, the first thing the lender has to do is to determine the reliability of the financial statements provided by the SME. This can be achieved by cross-referencing and validating the information provided against other documentation provided by the SME, including bank statements, VAT and PAYE returns, insurance certificates, and conducting trade references with the business's customers and suppliers. Excuse me. Credit providers have the ability to quickly and easily determine whether the financial statements provided by the SME are reliable or not. And if the financial statements supplied by the SME are not reliable, a credit provider can either decline the loan or reduce the amount of funding it is willing to extend to the SME borrower. And we always encourage SMEs to focus on ensuring that it has consistent and reliable reporting, because this is key in terms of accessing credit terms and actual access to funding. So how do lenders determine affordability? If the financial information provided is reliable, then the credit provider can easily determine the SME's affordability. To determine affordability, a credit provider assesses the business's trading history, profitability, liquidity, solvency, and availability of security. Let's go into each one of these components. Trading history. Most lenders and suppliers are likely to request around 3 years of financial statements. In the case of Brighton, we only require businesses to have an operating history of 12 months, but I'll continue making that sale a little bit later on in the conversation. These 3-year financial statements enable a credit provider to assess the business's trading history. This information can be extracted from the financial statements. So, the information extracted from financial statements will initially allow a credit provider to establish the size of the business in terms of its turnover, establish whether that business is a small, micro, or medium enterprise. But this determination or categorization of whether small, micro, or medium is actually substantially driven by the sector in which the small business operates. So a small business in construction, or a small business in services, no, my apologies. A small business in construction might be a medium business in services. So the size of the revenue is not the sole determinant of whether the business is small, micro, or medium. Also from the financial statements, a lender can determine the consistency of the SME's revenue and determine whether the sales are increasing or declining, and determine whether the business is declining or growing. In terms of profitability, the income statement allows the lender to easily determine whether the business historically has the ability to generate profits. And from these income statement they can also determine the gross, operating, and net profit margins, which obviously are relative to revenue, and compare whether these profit margins are in line with the sector average or below or above the sector averages, the relevant economic sector averages. From this assessment, the lenders can then determine whether the business generates sufficient profits and free cash flows to pay its existing short-term debt obligations. Should the business not be able to generate the sufficient free cash flows to meet its existing short-term debt obligations, it is highly unlikely that it will be able to afford and sustain additional or new debt. In terms of liquidity, from the balance sheet, the lenders can quickly assess liquidity. In assessing the liquidity, the credit provider assesses the business current assets, which namely are the cash available on the balance sheet, the size of the debtors, and inventory or /stock. And it compares these current assets against the business's current liabilities, namely its creditors, its short-term debt obligations or debt obligations which are due within the next 12 months, its short-term lease obligations, and its SARS obligations. What's important is that the analysis of liquidity shows that in the event of the business's distress, like the one we are currently facing with COVID-19, the business has sufficient current assets that it can quickly and easily convert into cash to enable it to meet its short-term obligations and continue trading. Reminder again, current assets are cash, debtors, and inventories, which can easily be converted into cash. However, should the current liabilities exceed current assets, then there is obvious concern that the business may lack the ability in a crisis like this to meet its short-term obligations when they become due, raising the concern on the business's ability to sustain trading in this environment, or in an environment where there's a decline of revenues, which a lot of businesses are anticipating with the continuing recession. Further, credit providers use the debtors and creditors age analysis to determine, in respect to debtors age analysis, to determine how well your customers pay you, and to establish how reliable your customers are in paying their outstanding invoices. And in terms of creditors age analysis, how well you pay suppliers, and confirm whether the business does in fact generate sufficient cash flows to meet its supplier payments. In terms of solvency, from the balance sheet, lenders can quickly determine solvency, whether the business liabilities, total liabilities, exceeds the business's total assets. Should liabilities exceed total assets, the business is deemed to be technically insolvent, raising concern about the business's capacity to meet its long-term liabilities, and more importantly, for credit providers, the business's capacity to afford and sustain additional or new debt. Lastly, credit providers also look at the availability of security on the balance sheet. From the balance sheet, lenders can determine the availability of tangible security. And this allows them to determine whether in the event of default, that business has sufficient tangible assets that upon a fire sale of the business's assets, the business can cover its outstanding liabilities. Credit providers, especially banks, calculate the loss given default, which is how much they expect to collect should the borrower default. This is why lenders typically require cession of assets so that they are first in line to be paid from the sale of these specific assets. And from the sale of these specific assets, they are paid in full before any other creditors are settled. So that is the importance to many lenders in terms of the requirement of security. So that for us is the conclusion in terms of the overview of how lenders and suppliers, what factors they consider in determining whether to provide credit or extend credit terms to SMEs. So I don't know if some of you saw our Take Action Now emailer that we sent about 2-3 weeks ago. The reality is small businesses have to take action now. You cannot wait. You cannot be patient. You cannot wait to see how things play out. Unfortunately, small businesses at this stage have to prepare for the worst. And in preparing for the worst, you have to preserve cash. And we go into detail on this quite a bit in our email. Businesses have to preserve cash. Over and above preserving its existing cash, they have to secure additional funding facilities. And the reason behind this, it is highly likely that most SMEs will require external funding to meet their short-term operational obligations over the next 3 to 6 months, as a result of the drop in sales due to lockdown and the continuing recession. So don't wait until after lockdown to apply for working capital or any other funding. And you have to use your most recent financial information to apply. This recent information will show that your business, at least historically, has the ability to generate revenues, profitability, and free cash flows, which will demonstrate your business's ability to service these new debt obligations once the lockdown ends. Because, and again, I'm going to make this point, lenders and credit providers will look primarily at the quality of your balance sheet and your ability to generate free cash flows to determine whether to extend funding or extend credit terms to you. If you don't mind, before we continue with Q&A, I just want to do a little sales splurge for 1 minute on Brighton Capital, as Koena did. Unlike traditional lenders, which we discussed quite a bit here, Brighton Capital has adopted an innovative approach to small business lending by focusing on and understanding a small business's products and services, its operating capacity and capabilities, and its cash flows. We use this understanding of your business to determine an appropriate funding solution that best reflects your business position and funding needs. As such, this innovative approach has allowed us to adopt a funding criteria that is more flexible than traditional lenders. We, as a minimum, look for fund businesses with a 12-month trading history who expect to generate a turnover of at least R1 million and have a track record of supplying goods and services to mid-size and large corporates and other public sector clients. Our online application is quick and simple. We only rely on easily accessible financial information. And your funding facility, as Koena indicated, can be approved within 24 hours, and you can draw your facility in as little as 4 hours. Our facilities are on a revolving basis, so each time you do a loan, you don't have to go through the same process of applying again. So please give us a call. Our contact team is waiting, and see how we can assist you on your next procurement opportunity. Thank you very much. Heidi, we can take questions now.
Awesome. Thank you so much, Tsepo. That was really enlightening, and I hope that our attendees today and participants got some valuable information out of that. I think let's go to Koena. He's got some of the questions that we did receive prior to the webinar on our hello@BrightonCapital address. So Koena, I think you're on mute, so let's unmute.
Okay,
and
there we go.
you can ask, you can just go through some of the questions that we received prior to this webinar, but
Okay.
we're also opening the questions to anyone in the audience to ask questions directly to Tsepo and Koena on any topic related to small business financing or anything that you think we could help you with. If you do answer the question, please just click on the Q&A icon on the Zoom meeting, and then that's how you can ask a question. You can just type it in there and we'll pick it up and we'll relay it to our team to answer. But let's answer the ones that we received prior to the webinar for now.
Okay, let me look up one or two questions that came in. I'm going to start with one from Simpiwa from Ermelo. His email reads, my business has been going for a long time, but I've never needed financial statements before. Where do I start with getting financial statements for my business, and what information is needed to do financial statements? Tsepo will be able to touch on that.
So I think we've gone into quite a bit of detail in this presentation on that, what the importance of financial statements are. I think the first point of call is for some people to engage a smaller accounting firm, which can utilize Simpiwa's bank statements to at least prepare the income statement. And obviously, Simpiwa will have to work with that accounting firm to establish its balance sheet from terms of its assets and liabilities. And that obviously will form the foundation of Simpiwa generating financial statements. As we talked about quite in detail, financial statements are a very important source of information for a credit provider to determine whether to extend funding to an SME. The reality is a credit provider in a lot of times, not including Brighton, may decline the extension of credit because an SME does not have financial statements. So there is no downside for Simpiwa to work with a small accounting firm to help him prepare financial statements on a periodic basis.
Okay. There is a hand has been raised by Zandisile. I'm thinking, Heidi, are you able to unmute Zandisile so she can ask the question? She, sorry.
Hi, Koena. Yes, I will. Zandisile, you are welcome to ask your question. We have given you, we've unmuted you, so please go ahead and ask your question. Can you hear us? Are you able to chat? I think you are. Zandisile Klope, if you're able to hear us, I see that you've got, I think Zandisile is not logged on with audio. So perhaps let's move on to the next question, and Zandisile, you can just try and add your audio to the Zoom call, or alternatively just type in your question and we will relay it here.
Okay, and then there's a question now that just came in from Elsie Williams. Also is asking, what is the interest rate on a loan And what will the repayment months be? So Elsie is asking with regards to loans that are long-term. She's mentioned here 60 months, which unfortunately is not a type of loan that we provide. We only provide short-term working capital finance loans. Longest period we'll probably provide for a loan is going to be 90 days. So we're looking at around 3 months, give or take. So I don't know, Tsepo, if you want to touch on pricing with regards to our short-term working capital finance loans.
You know, one of the things that we've built is a great tool on our website that allows a client of ours to determine very quickly, based on the type of product they require, what our funding cost will be, because it does vary between in terms of the length of the loan. It does vary in terms of the type of the loan that we extend. So please, Elsie, I would encourage you to go to www.brightoncapital.co.za for you to understand how our pricing works.
Thanks, Tsepo. I have unmuted Elsie as well. So Elsie, if you can just join with your audio, so you'll find a setting there that adds you to the audio, and then if you'd like to ask, add on to that question, you're welcome to. Koena, I see that we've got another 2 questions from Devin and Billy, yes. So if you want to go through those, let's maybe take those.
Okay. So let me start with Billy's one. Billy's asking, is it important that a borrower provides a PO, a purchase order, or you also look at financial statements? So I'm assuming that, do we look at financial statements solely? No. So how it works with regards to our PO funding, it is definitely required that the client must have a purchase order from a large corporate client or a government entity, in order to be able to get a loan from us. Okay, so that is fundamental. We also do provide invoice financing where a PO will be required, but obviously you will have delivered on the goods or services by the time you submit your invoice. So the answer, Billy, is yes, you do have to have a purchase order in order to get funding, especially on a PO, one of our purchase order finance products. Do we look at financial statements? We only look at financial statements in the way that Tsepo was explaining earlier, with regards to us assessing your credit risk as a business, and also checking your profitability and so forth as a business. How Tsepo had explained earlier as how lenders look at financial statements. So in that case, in order to draw down from your facility, you would require a purchase order. Okay.
Well, let me just add there, if you don't mind.
Okay.
So for our invoice finance product and for our purchase order supply and deliver, we do not require an SME to provide us with financial statements. However, for our contract financing product and facilities, and for our purchase order manufacturing and assembly product, we do require an SME to provide us with their financial statements.
Okay. Okay. And Devin is also asking, do you offer longer term working capital finance?
Okay, let me answer that thing. So Devin, if you do have a contract, depending on the length of the contract, we will obviously develop a funding structure for you that obviously suits and matches the length of that contract. It is typically a revolving contract facility. So you are drawing from the facility, and then you are obviously always on a monthly basis paying it back and redrawing from it again. So it does depend on the length of your contract, and it's only in respect to our contract finance product where we do duration of loans longer than 3 months.
Okay. While we wait for other questions, there is another question I want to bring up that we received via email. So there is a Tando from Rustenburg is asking, can I still get financed if my business is not profitable? Okay, so my business has been breaking even for a year, but we are not profitable yet. So it's asking if you'd be able to get finance in that type of scenario.
So the answer is sorry, what's the gentleman's name?
Tando.
Tando. The answer to Tando, his or her question, is yes, as long as the business is sustainable and the business can meet its short-term obligations in the form of either salary payments, supply payments, or even its existing debt obligations.
Okay. I think for now, there was another questions with regards to how long it takes to draw down or get a loan from Approved for Working Capital. I think we did touch on that. So those are the questions that we received via our email previously before the webinar began. And I don't know if there's anybody else currently that is online that would have any additional question that may want to ask.
Tsepo, I have unmuted some of the participants, so if anyone would like to ask another question, we can unmute you. You would need to join with your audio in order to answer a question. So I'm just going to open it to the floor now. I think, Billy, are you, I've unmuted you. Billy Radebe, you should be able to ask a question, or if you want to add to this discussion, you're welcome to do so now. Hi, Billy, can you hear us? Billy, we don't hear you, so let me open it up to the floor. I didn't hear that. Okay. All right. So I think that we have answered some of the questions that have come through today. We haven't had any. Oh, who's putting up their hand? We haven't had any further questions from anyone else in the audience. I'm just going to unmute everyone here so that if you do have a question, you can ask it now. You can also unmute your own mic. If we've given you access to this, all you need to do is unmute your own mic, because I think that's a default setting. So we'll just give everyone a couple of minutes in case they would like to add to the discussion or ask any further questions. Koena and Tsepo are very experienced in lending to small businesses. This has been a business that we've been involved with for 5 years. So they've had a lot of experience with helping SMEs. So if you do have a question, now is a good time to ask it, because it's not often that you get to talk to the CEO of a lending company. So please feel free to take that opportunity if you'd like. All right, so I've unmuted. Any further questions from anyone? I see there's another question. Oh, Billy says that his mic is not working. Okay, no worries, Billy. Not to worry about that. You know how to get hold of us if you need to. So, Tsepo or Koena, any final comments to our audience today who have been so generous with their time to join us? Please feel free to wrap it up.
So from my perspective, just the conclusion is, again, I can't emphasize it enough. Businesses have to take action now. They have to preserve cash. They have to cut cut right down to the bone to ensure that there is as much cash flows coming in and as little cash flows going out. Further, I really do believe that businesses have to position themselves to access funding, whether it is from a government source, whether it is from the guarantee scheme that National Treasuries run, whether it is from us. It is really, really important right now to use the most recent financial information to raise cash, because cash is what's going to give you the ability to withstand the storm. It's not a difficult equation. You need cash to sustain yourself. It is the oil that sustains businesses. And without that oil, you cannot meet your short-term obligations. As such, even when the opportunities do present themselves in the future, you will not have the cash flow required to pay suppliers, pay the staff, to deliver on those opportunities. So it is beyond critical right now. Preserve cash and make sure that you are accessing as much cash as available to withstand this storm that is COVID-19. We have no clue how long it's going to stay with us. We have no clue. Yes, the hard lockdown is coming to an end, but we do not know when we'll get down to level 0. And we do not know to what extent sales will pick up. And if sales don't pick up, is the business still able to generate free cash flows like we discussed early on?
Yeah. No, I don't have anything to add to that from my side. I think that's a good conclusion to this discussion.
Okay, brilliant. Well, thank you so much, Koena and Tsepo, for your time today. And I hope that our participants got a little bit of an insight as to what lenders are looking for when they are deciding whether or not to lend you money. You are welcome to, anyone who's joined the call today or any other small business that you know, are welcome to go and have a look at our website, which is at www.brightoncapital.co.za. On that website, you will also find an email address and a phone number if you need to get a hold of us. You know, we are a company that really focuses on understanding your business, and we're not like the bank. You know, if the bank has rejected you, come talk to us, because we are here to help small businesses and try and make sure that we can help where we can. So with that, I'll conclude the webinar.